One of the key differentiators, at least from how I like to work, is that I usually don't do an actual versus budget. I always go out a forecast versus target.
Mhm.
Actual versus budget is more about a point in time, and it's great for large companies. I mean, I grew up in an environment where lots of corporations have actual versus budget, so we're all kind of known to that piece. But it's a point in time of where are we against our budget today. A forecast versus target is saying, are we going to make it or not? And to me, as a business owner, that means a lot more than, hey, here's you're over budget in marketing today. I'm like, great, to me, it's like, great. What does that mean?
Yeah,
Right.
absolutely.
So it's really about telling that story, and the forecast was the target tells you that full story, whether we're going to make it or not. One of the
Yeah, so welcome everyone. Thanks for joining us for another Law Firm Growth Ideas session. I'm Sharon Means. I'm a fractional integrator for law firms that are running on EOS, which is the Entrepreneurial Operating System. And before we get started with our guest speaker today, I would like to take a few minutes just to talk about the Law Firm Growth Ideas. And this group was created because we saw a gap in the legal industry. Law firm owners are constantly being offered lots of information, webinars, CLEs, podcasts. But what we really need is practical ideas from people who are actually helping law firms. And so Law Firm Growth Ideas was brought together by a few individuals. Rav, who's on this call, who brings deep experience helping law firms drive growth and improve business development. Joe is not here today, but he provides expertise in public relations, branding, and helping firms tell their story. And Matthew, who is also not able to join us, helps law firms leverage technology, cybersecurity, and IT infrastructure to support growth and efficiency. And together, we're helping law firms bring practical strategies they can implement, not theory or hype. So today, I'm excited to introduce Rush Shaw. Rush is a personal friend of mine. He works with professional service firms and to help owners better understand the financial side of their business. He's a fractional CFO and he helps law firms translate financial data into business decisions that can help owners actually run a healthier company. And the reason why I wanted to introduce him to law firms is that, lots of times people feel stressed out about money. They're not profitable. They don't understand the numbers. And so this lack of financial clarity and understanding of what the numbers are actually saying is what Rush helps out with. So today we're going to have a conversation based on some common financial mistakes that law firm owners make, and also what is the difference between a CFO and a controller or accounting manager, what have you. And then we're going to go over some practical tips on profitability, pricing, capacity, and growth. So with that, thank you, Rush, for joining us.
Yeah, thank you, Sharon. Thank you for having me. Hello, everyone. Give me just a moment while I share my screen and start my presentation. So
Excellent.
you should be able to see my screen here. And let me hit start from a slideshow. Wonderful. So again, my name is Rush Shaw. I'm a fractional CFO, and today I'm going to talk about the three most common mistakes firms make when it comes to financials and what you should know to avoid those mistakes. A little bit about me. I'm based in Los Angeles, California. My career journey spans over 20 plus years of experience in finance. So I've had leadership roles in Fortune 500 companies along with small businesses. My entrepreneurial journey started back in 2024. It started when I realized that there are a lot of small businesses that are just trying to figure out how to manage their growth that they have. Particularly on law firms, they're saying, hey, we want to grow. When should we hire? How should we hire? And so I created my company to help solve that issue. So today's agenda, we're going to talk about the three most common financial mistakes. I'm actually going to run through a scenario of a law firm that will cover of applying some of these, guidelines that I give. And then I'm going to talk a little bit about how the CFO keeps the firm on track. And then we conclude with questions at the end. If there are questions in between each of these sections, I'll open up to questions as they come, and otherwise I'll just keep moving on.
Yeah, I'll keep an eye on the chat.
Perfect, thank you. So the three most common financial mistakes. Well, today we're going to cover these three components, right? There's a misalignment between roles and functions. So I'm going to talk about the difference between a controller and a CFO, or accounting and finance functions. I'm going to talk about how hiring the wrong type of CFO can affect your business and why fit matters more than just title. And then we're going to talk a little bit about why, oftentimes the CFO philosophy, where a lot of companies treat the margins as an afterthought. I'm going to talk about a philosophy that I've developed where we really start with another aspect of it, and because growth without margins is just a losing strategy, in my opinion. So roles and functions. So most firm owners really start with an issue around, you know, growth and who is going to help them with what. Now, on the world of finance, you have two components. You have tax and compliance, which is historical information, and you have the other realm of, well, what does the future look like for us? So to help discuss the past, you typically need a controller, right? As opposed to a CFO is helping you on future focus strategies. That's one of the biggest difference between these two roles. And importantly, it's the functions that they cover. A controller will typically cover your bookkeeping functions, right? Taxes, audit, month-end reporting. Now, the controller and the CFO are just titles. Please remember that, right? The functions are very different from the respect of what they do. As opposed, for example, a CFO is going to be working on your financial future, the planning, the analysis, managing the capital, the cash flow, and the risk around the company, as well KPI for more reporting. They're just very different mindsets. Now, we talk about the role, we talk about function. Well, also, one of the other questions I get asked is, well, what does a CPA do? Well, a CPA is just a licensed, licensed individual who has experience in accounting, right? They passed a test, they're very knowledgeable in the aspects of all accounting functions typically. And I do like to have controllers that are typically at a CPA level or have a designation as a CPA, because it helps me feel safe that they know all the realms of accounting that happen, because sometimes it can be quite a nuisance, right? Versus a CFO, it doesn't really matter what designation you have. Myself, for example, I have an MBA, right? But we're really the strategic thought leaders of saying, hey, how do we bring the company forward? So we
Yeah.
work hand in hand together.
Speaking as a CPA, I can tell you that, yeah, you basically are certified to do audits and taxes and what have you,
Yeah.
and there's a different level of school and test and whatnot, but yeah, it's
Yeah.
really good to have a delineation for these different functions, because I know you get that all the time, Rush, about like,
Hmm.
you know,
Yeah.
isn't my accounting firm also my CFO? And maybe, but probably not.
Yeah, absolutely. Just different two thoughts of thinking, right? And it's hard to do both. It's like trying to imagine trying to look backwards while trying to look forward at the same time.
Mhm.
It's kind of hard to do, right? And
Yeah.
that's why it's so hard oftentimes to switch gears between having a controller trying to do CFO work and CFO trying to do controller work. But just to do it effectively, most importantly, right?
Yep.
Now, the other common mistake is thinking there's a CFO is a CFO, right? But the truth is there's always different types of CFOs. And the key here is to hire the CFO based on the problem you need to solve. And what I'm trying to get here is that there are CFOs that focus on startups. And a startup needs going to be very different than the need of a service-based business from that perspective, right? So startup will be maybe focused on fundraising and burn rate and making sure that we can get funds. A service-based CFO, one maybe perhaps working with law firms, is going to be focused on utilization, project management, right? The cash flow timing of things. Um, Whereas someone who's product-based, maybe they're doing consumer packaged goods and manufacturing, they're going to have a different lens to view it. They're focused on cost of goods sold, managing the unit economics, managing inventory, for example. And again, you have PE-backed CFOs, they function differently than a nonprofit CFO. So not all CFOs are the same, right? And the third mistake often gets is that, well, they all do the same kind of thing. But the truth is their approach varies from many different aspects. You can have some CFOs who are just, for example, in a startup or early company saying, hey, we're going to grow at all costs, right? We'll scale later. We'll scale now, sorry, and focus on profit later. So they're really prioritizing top line revenue and focusing on that aggressive growth. My focus is more around a balanced growth approach, where we're going to talk about growth through efficiency. And the key here is to tie your targets to a margin threshold, right? Making sure you keep a certain percentage of what of your revenue that you keep at any given time. So we're talking about margins. I'll go into more details about this in a little bit later. But we only invest when we have the when we have the unit economics work for us. And the last type probably is more focused on capital allocation. This is when you have tons of money and trying to figure out what to do with that money, um, from that aspect. Or if you're trying to, if you're a manufacturing company, right, you're focused on the capital and allocating that piece. So let me talk about the balanced growth approach. Now, this triangle represents kind of the factors that drive a business: revenue to profit to cash. But in between are the factors we need to have to make it work, right? So you have revenue, or a net margin percent is really what's left of your profit number, for example, right? So take revenue times a percent number here and you get profit. Profit isn't the same as cash, for example, and that's where you need cash flow management. And sometimes it has to do with accounting rules, whether you're doing cash accounting or accrual-based accounting. And oftentimes it could be, if you're doing accrual accounting, it's going to hit on your books, but then you have things sitting in accounts receivable. So it's not going to show the same as your cash.
Yeah,
Right?
that's a typical question that I get
Yeah.
from
Yeah.
everyone is how is it that I made all this profit at the end of the year, but
Yeah.
that profit does not translate into cash? And like you said, it could
Yeah.
be
Yeah.
things like if you didn't collect on your AR, or you made some capital leasehold improvements, and those typically show up on the balance sheet. So those don't
Mhm.
show up on your P&L. So that wouldn't affect your profit, but it
Yeah.
certainly would affect the cash number.
Yeah, absolutely. And I always view cash as what is in the bank, what is coming in and out of the bank. And I use the profit more as like, well, what's the accounting regulations around what we should book it under,
Yeah.
right? The profit loss statements typically it can be very detailed. I mean, you'll have marketing separated, you'll have all these different things separated versus a bank. It doesn't really matter what's in what category it goes
Yeah,
under. It's just here's the money in, here's the money out, right?
absolutely.
Um, and so when you have that cash, you can invest back in revenue. So the biggest mistakes that I see for business owners is they start at revenue. And the issue with starting at revenue is that your profit becomes an afterthought, basically, right? So, or margin, basically, right? You're basically saying, look, I'll grow my revenue, whatever expenses happen, is happen, and whatever's left at the end is left at the end of the day, right? Making things unpredictable. There is no strategy around uh, managing your money, except for the fact that you're just so focused on growth and revenue. Instead, what I say is start here. Start with solidifying your net margin for your business so that when you start here, you know your profits are going to be coming in no matter what. Then you hire a professional manager, cash, right? Then you have cash that you can reinvest back in revenue. So once you have solidified these areas, you can then grow at a constant manner.
Yeah, because what I see a lot in the firms that I work with
Yeah.
is that they get to $1 to $3 million and they think that that is repeatable. And
Yeah.
so they hire, two or three partners or what have you. And what
Yeah.
ends up happening is they make actually less net margin with
Mm-hmm.
the growth because
Yeah.
have to put an infrastructure in place, and so
Mm-hmm.
they're focused on revenue. So maybe they do get to a $5 million firm, but they're
Yeah.
actually making less. And so then you have to say to yourself, well, what happened there and what can we do about it? But when you're looking at this first, then you can
Mm-hmm.
realize that sooner. And yeah, there's also a whole mindset with profit first that they have a book on. And you put your profit or what you want to pay yourself into a separate bank account.
Mm-hmm.
And so that, you always you pay yourself first, but that also has to do with, making sure that there's enough net margin to cover that.
Yeah, absolutely. And the key to net margin is that, it's a percent of revenue. So no matter where you scale, whether you're at $1 million or $10 million or $15 million, you're always keeping that same percentage as a percent of their revenue. Versus if it's a profit number, the margin can go up and down at different times, right? So that's a big component of the net margin percent. And this is why I'm so focused on the margin itself.
Mhm.
And so to cover these 3 points, and before I go to my scenario, which I'll go next, right? The three main things I cover here is that the role that you have matters. There's a difference between accurate reporting and strategic guidance. The CFO fit matters too, right? Depending on the stage you're at, the goals and the operating model you wish to have. And most of all, at least for me, depending on because I'm a service-based CFO, the margin discipline matters, right? Growth becomes stronger when you have a margin built in for your plan. And with that, I'm actually going to give a scenario of how this applies to a law firm. So our scenario is going to work on a trust and estates law firm here. I'm going to show the financials, and we're going to go a little bit dive deeper into the numbers here. So if you're afraid of numbers, I'll try to make it as easy as possible, as simple as possible here. But basically, if we look at the current financials, right, in the past year, this company had 379 client matters. On average, let's just in this example, we'll say they have one service package they're selling constantly. That's about a $5,000 package, right? 379 times 5,000 gets us to a revenue. Now this is in thousands over here, so it's 1.895 million, right? So if you think about the percentages here, this is what I'm talking about margin. For every dollar that you earn, how much is going away out of your business? So 49 cents on a dollar or $924,000 is going to your cost of service. And what I put in the cost of service is really what are the things related to those billable hours that you have versus I'm separating operating expense down here, like operational overhead for like a building lease expenses down here, or your admin staff, right? They're not really directly billing to a client, so they belong down here. Which, as you can see, things start to go down further and further from that standpoint, right? So 26 cents on a dollar here has gone towards expenses. So you take away the 49%, you take away the 26, you're left with another 25% in net margin. This is what I'm talking about when I mean margins here. So, well, as I mentioned, I'm going to work the other way. So we're going to talk about a goal. So if a firm says, hey, Rush, you know what? Great, that was last year. The past is the past. I want to talk about the future. I need my margins to be at least 35%, right? And you know what? I'm okay with growing. We're going to add 60 new client matters per year. And I'm willing to increase my rate up to a point, up to maybe 10%. I also want to add a legal assistant to my team. And for other salaries and overhead, we'll do modest increases, to account for inflation. So how do I approach this from a CFO standpoint? Now I'm just giving goals and constraints to work with, right? The future is unknown. Well, first I need to define my roles of who's working on what, right? I'm going to be depending on the controller or accountant or bookkeeper, whoever you're working with that does your accounting to make sure are my reports correct? Are we in compliance? Do we make sure are we fortified against any accounting risks that we have? And do we have the processes and systems in place to make sure that we get regular, accurate data, right? So
Yeah,
this is
because
so important for a firm.
Rush can't do his job as the CFO
Yes.
if that whole part isn't done. Like the
Yeah.
screen that was before was a very nicely laid out, but if you
Yeah.
don't have something like that, you really, you have to take a step back because I see a lot of firms that jump in and say, "Oh, our accounting's a mess. We need a CFO," and it's like they really just kind of
Mhm.
need to get their accounting in order to
Right.
jump down to that next step.
And any good CFO who will come in and sees that accounting is a mess is saying,
Yeah,
you know
won't
what, we need to
touch
go
it.
fix accounting.
Yep.
And and the truth is, look, maybe depending on CFO's experience, they could do that for you, but that's going to be a pretty expensive cost to have to someone do all your
Yeah.
books, right? So oftentimes you either outsource this or you have a team that does this piece, and your CFO really comes in for a high level strategy piece. So they can really work on really the big pieces here. How will we hit the target? What are the risks involved? And do we have the capital needed for growth, right? Um, and any questions so far yet that I should address before I move
No.
forward? Okay, great. Thank you.
Oh, wait, somebody does. So Rob says, in a hypothetical scenario, if one invests cash in hiring a new admin staff, say an intake specialist, or adds an additional 10K per month in marketing, it will bring down the net margin. How long do we plan to get back to the net margin prior to the investment? Yeah, so that's a really good question. I think he's going to cover that while you're seeing the numbers
Yes.
change, because, the
Yes.
thing is you can press a lever, but then like what happens when you still want to keep, your margins up? You gotta do something else, obviously. So thanks for the question.
Yeah. Yeah, and this is where I wanted to show that the idea of the growth is great. You do want to hire somebody, but you also need to recoup your costs and at the same time still make money. So the questions become around, well, what should I price? What number do I need to hit in order to recoup my costs and still make money, right? So I'll cover that as we move forward.
Yeah.
So we're going to go with this. So how do I develop my target as a CFO? Well, first of all, remember I was talking about methodologies of a CFO, the different approaches. Well, my approach is based on a margin-based pricing model. So I start with the margin first, not the revenue. And in order for me to do that, the first thing I have to ask is what margin do you want? Then I'm going to determine my constraints. So who are we hiring? When are we hiring them? What are the costs associated? And then I'm going to look at the number of hours it takes for us to do each matter in general. Um, and keep in mind this example like I gave does not apply to every single law firm out there. I mean, there's different types of lawyers. Some are paid on contingency, some are paid on different models. But I just want to give an example of one here that this can apply to oftentimes. And then we'll look at the financials and the capacity. There's going to be another component. The capacity really will determine when you need to hire somebody else. So let's start with what I'm giving first. Hey, Rush, I want a 35% margin. And that's my goal, right? So every client matter that I bill out or price that should produce at least this margin. Okay, we can do that. But I have constraints. Here is what it costs me for all my staff. I have a partner, associate attorney, staff attorney, paralegal, and a legal assistant that I just hired. This is their cost after taxes and benefits. I usually use a 30 to 35% tax and benefits factor on top of their gross salary, because again, that's something we always have to pay for from that standpoint. But keep this number in mind, not mine, 968,500, right, for my cost of service for the labor. And everybody is 40 hours a week, so I'm going to use that as well. FTE is another term that I like to use oftentimes, right? Next, my operational staff. So I have an office manager and admin. I have a bookkeeping press. Maybe I'm outsourcing this a little bit to keep my books in order. So this cost is 148,500. And then I have my operational overhead, right? My rent, my marketing is what you were asking, software, various things. So 380 is what I anticipate to have. So I have all these expenses that are coming up for me. But then I know there's also limits. So for this package that I have, I need a certain amount of time for everybody on my team. And the partner's going to take about an hour to do their work. My associate attorney takes about 3. My staffer need another 4, a 4, and a 3. So these are just rough estimates. So it takes 15 hours of time for each of these matters for me to complete that work on a rough basis, right? Then I also have costs that come with each matter as well, roughly. So now I know everything that I have. So what do I do next? Well, there's a back-end formula that I like to use, but I want to show you the output of that formula, right? So now that we have defined our labor hours and cost structure, we need to test whether the matter volume preserves our net margin. So based on my calculation, I say that we need about 437 matters for the year, with 15 matters per hour. And what I have done here is I've actually worked backwards to the number because I know my constraints. Look at this labor, 968,500, right? This product is actually 150 times the 37, so 65,000 for that. OpEx staff I talked about, 148,500, right? So I know all my costs are now correctly associated here that I have. And if I want a 35% margin, I got to work backwards to say, hey, what do I need to have? So I need about $2.2 million to get to where I want to be, right? Well, what is my price per matter? Well, in this case, it's 150, 5,100, for example, in this. So you need this component. So sorry, let me rephrase it. Your total revenue is 5,500. So this is what you'd be charging per matter. Um, right. And then this is your cost of labor per matter. See, everything per matter, but guess what? It's still at a 35% margin. Fine. Well, I charge per hour. Great. Okay, let's do a matter per hour that you bill out. Still at the 35% margin here. So, and now I'm saying, look, you can bill at minimum up to 367. Now, if you want to bill 500, great, go for it. No one's going to stop you. It's what the market determines. But in order to preserve your margin, you got to bill at least 367 an hour, right? Any questions so far on this?
Yeah, and that was that per matter number in the middle was that
Yeah.
10% additional that you said
Hmm.
to
Yeah.
raise it. So it was at
Yeah.
5 and now we're talking 5,500.
5,500.
So
Yep,
that helps
exactly.
as well, again,
Yeah. So,
recoup some of the costs.
yeah. So if we look at it in total, before I go to the next slide, I mean, what I'm showing here is that at different levels, it's the same margin. The profit stays intact at each level. The numbers are different, yes, but the margin here for every dollar that I earn, I know I'm getting 35 cents on the dollar. I don't have to worry about whether it's going to go up or down. Assuming, of course, that I hit 437 matters from that
Yeah,
standpoint, right?
correct.
But now all I need to do is like, look, I know how many matters I need to hit. If I hit this at this at this price, I'm gonna make the money I want to make. Right? It's one less variable for you to think about. And then I want to talk about the capacity, right? Now, just because you're one FTE, one FTE is typically about 20, 80 hours a year. We know you're not going to be billing 20, 80 hours per year. So there's a partner can bill a certain percentage, associate each of these have a certain percentage of that pool that they can bill out because they're either be on vacation, networking, out getting business, right? So this is their capacity, and based on my calculations of those matters that I have, this is how many hours it takes. So what I've shown here is that, look, everybody is, okay, they're over 100%, but I'm not really worried unless the risk is over 150% of capacity, right? I can take 20% up and down. They can maybe do less networking and more time on the billable hours that we need to do, right? We can play around with that, but by the time you hit over 150% capacity, there's not much leeway you have. So here, this lets me know, you know what, I'm okay to keep where I am and bill where I am and not have to worry about capacity yet. So my question is, did we hit our goals? So as I talked about, 437 in climb matters. That was about 58 new ones. And I said they can add up to 60. Check. So we hit that. They said, look, my average amount per climb matter, 5,500 right now, up 10%. Okay, wonderful. We hit that, right? These two combined equal a larger percent of your change. Now I'm up $500,000 from this. I
Mhm.
added a legal assistant. Okay, wonderful. Just because I added 509, my cost went up a little bit. I'm still up from that standpoint. And then does this allow for modest increases? Sure. There's not much dollar changes here, but it's a small increase. But look at where I landed. Just by a small increase here, just by two major changes here within the means, I'm able to make $365,000 more in my firm with a 35% margin. 365,000 more. That's a pretty big chunk, in my opinion.
Yes.
Right. And you haven't added any new persons except for a legal hire that you hired.
Which of course frees up some of your more expensive staff to do more of the
Yes.
roles. And yeah,
Yeah.
a good legal assistant is definitely worth a hire.
Yeah. And so we hit this goal. But I'm on the next question I'm asking, why? Why am I focused on margin? Why not just focus on the profit target? Right. Well, if I'm going to do a scenario here where I don't change anything, my only focus is growth to reach a profit target. So I'm saying, you know what, my margins are 25%. Rush, you know what? I don't want to do this margin based thing. I'm happy where I am. I just want to hit $841,000 in profit. I don't want to change my price and I'm good where I am. I'm like, okay. So I know the numbers we're at right now, right? If I were just going to do no other changes but instead trying to hit that target number, how much revenue will I need and how many climb matters do I need to hit that 25% margin, keep everything the same, but increase profit, right? Well, quite a bit actually. If I look at these numbers here, I need about 1.5 million more dollars to hit that profit, and I have to hit 200, almost 300 new client matters to get to that number, as opposed to a margin-based factor where I only need $509 new revenue, right? And a couple more client matters within 50, 58 new ones to hit what I want, with just a 10% increase basis points on my net margin. Does this make sense? Like, I hope this allows you to understand like why there's a cost of inaction. There's a cost of doing nothing here.
Yeah,
Right.
absolutely. It's like I was saying, it's like the levers that you're pulling and making sure that they're all on track because two, you can increase your revenue and not
Mhm.
think about capacity, which I know you're going to talk about maybe a little more, but
Yeah.
then you burn people out and then the good
Yes.
people leave because they don't want to put in 20, 80 hours a
Yeah.
year in
Hmm.
total billable. And
Yep.
then you're just stuck with the people that, are your lower performers and can't really do this work anyway.
Yeah. Think about it. Here we only went up 58. You got to go up
That's what I'm saying.
300, right? 5 times more. And I know for sure you're going to be maxed out at capacity. So guess what? You're going to have to hire somebody new, which is what it's going to take away your margin here. Right?
Hmm.
And I just assume I'm going to keep it the same. But this is why growth alone doesn't solve a lot of issues. This is why I say it's growth through efficiency. And this is why we are so focused on the net margin here. Yeah. Any questions so far on this?
Nope.
Okay. Yeah, wonderful. So then let me keep going on this on the next part, right? How does a CFO then keep the firm on track? Well, this is typically my process for engagement, right? The first thing we ever do is we work on the targets. Okay, where do we want? What margins do we want? Are we going to be hit the goals? But I also have to track how we're doing on a month-to-month basis. So what I mean is that we need to strategize around, are we going to hit these targets or not? And then when I analyze that data, and every single month, I'm going to look for ways we can optimize to make sure we never go off track to hitting our target. And this is where a CFO really helps because I can tell you early on, whether we're going to hit this target or not and why we're not going to hit this target. Because I'm analyzing that data saying, look, when we said we're going to hit this amount of matters and we're losing it, we're not making it. Well, look, we never spent any money on marketing. We didn't do this, we didn't do that, or whatever it is. Or, hey, this is not an effective matter for us to do it. And then we continue to optimize to say, hey, what is happening here? How can we make it better? And does it go back to our strategy that we developed in terms of hitting our targets? So when you're continuously proactive on this is when you can hit your results that you want, where you can maximize your profits, sustain your growth, and obviously boost your valuation at the end of the day. And so, any questions on that other last slide before I move on?
No, I would say that you're kind of like in my business, it's a lot of accountability. So it's being
Yeah.
accountable and looking at these things
Yes.
proactively and a month by month basis,
Yeah.
because a lot of firm owners don't want to look at the finances and they think that numbers are scary, like you said before. And so
Yeah.
now, looking at them, you can shed some light on what's happening and make course corrections before, hey, you have to give your financials to your tax accountant and they,
Hmm.
and then it's way, way too late. So working with somebody like you really
Yeah.
keeps people on track because there's an accountability aspect that they're going to have to look at it and we're going to have to make suggestions and corrections.
Yeah, and one of the key differentiators is, at least from how I like to work, is that I usually don't do an actual versus budget. I always go out a forecast versus target.
Mhm.
Actual versus budget is more about a point in time, and it's great for large companies. I mean, I grew up in an environment where lots of corporations have actual versus budget, so we're all kind of known to that piece. But it's a point in time of where are we against our budget today. A forecast versus target is saying, are we going to make it or not? And to me, as a business owner, that means a lot more than, hey, here's you're over budget in marketing today. I'm like, great, to me, it's like, great. What does that mean?
Yeah,
Right.
absolutely.
So it's really about telling that story, and the forecast was the target tells you that full story, whether we're going to make it or not. So final takeaways. So in this presentation, we talked about how important roles are for your accounting firm. We talked about how important fit matters, and third, we talked about why margin matters in a business, and I gave a whole scenario about that piece. And a sustainable growth starts with the margin discipline, not just revenue alone for a business. And one word of thought, right? A reactive approach responds to what happened. A proactive approach shapes what happens next. And so that's the role of the proactive CFO leadership that we focus on. So from that standpoint, I leave it up to questions. Any questions so far? Okay.
No.
Otherwise, I'm going to go ahead and share my information. My website is here, my email is here as well, and my phone number. I do offer a complimentary assessment. If you want to learn a little bit more about your business or see where their opportunities are, please just contact me and I can do a whole assessment for you of your business and hitting those goals that you want. But that is it from my standpoint.
Excellent. Well,
Yeah.
Thank you very much, Rush.
Yeah, appreciate it. Thank you.
Ends our presentation for today. We
Yeah.
do this monthly, but we have not scheduled our next month yet, so we're gonna look into that and possibly take a hiatus over summer. But really appreciate all those tips and tricks, Rush, and highly encourage anyone who is interested in a CFO and doesn't really know what a CFO does. I get that all the time. Contact Rush and he'd be happy to have a consultation with you. So thank you again for joining us.
Appreciate it. Thank you, everyone. Thank you. Bye. Bye.